Hello and welcome to this week's Protection Update. Now, on Wednesday of this week, we looked at the subject of trusts on our Writing Protection Policies into Trust webinar. Did you attend? I know quite a few of you did, but if you did miss out and you do want to attend, we are running one more of these webinars next Tuesday, the 22nd of February, and it'll start at 10 o'clock in the morning. I've added a registration link to this week's Protection Update. Now, this week, I had a couple of conversations with Tammy Cook from Home Finance Solutions. Hello, Tammy. And we spoke about a trust query, and I wanted to share it with you and make it this week's main topic in this protection update, as I think there are some good sales angles here and reasons potentially to get back in touch with some of your clients. Now, the query concerns what to do when you've got a couple of unmarried clients who need some protection cover, and we're talking specifically life insurance. How do you set up cover for them? Well, let's just say that you've arranged a joint mortgage. Should you write a joint life first death life assurance policy for an unmarried couple? Well, maybe, but maybe not. Let me explain what I mean. If a couple aren't married, they're not each other's next of kin. The idea behind a joint life first death policy is that when one of the lives assured dies, the other one can make a claim and they will receive the policy proceeds. And that's what happens whether the clients are married or whether the clients are not married, if they happen to be lives assured and plan owners of a joint life first death policy. So why did I hesitate? Why is it a problem? Well, it's to do with HMRC. Let me give you the legal explanation. If a joint life first death policy is held by an unmarried couple, in the event of a claim, because one of the lives assured has died, the life company will deal with the surviving owner, and that's because they have legal title, and it comes under the Law of Property Act 1925. However, you've also got to consider what we call the beneficial interest, and that means that each person owns 50% of the beneficial interest in a jointly owned policy. So when one of the lives assured dies, the market value of their share, or half of the sum assured, is included within their IHT calculation, and this is as a gift to the survivor. That means 50% of the value of the policy is counted in the estate of the deceased partner, and that's even though the surviving partner has made the claim and received 100% of the policy sum assured. So, why is it an issue? Well, let's say the sum assured of the joint life policy is £300,000. You've effectively artificially inflated the estate of that deceased person by £150,000. Is that going to cause a tax charge for IHT? Maybe, maybe not. We just don't know whether this is going to be a problem in the future, because we don't know what someone's future worth is going to be, and we also don't know when they're going to die. But it is a problem specific to unmarried couples. But what's the answer? I remember personally selling lots of joint life policies to my mortgage clients, and I know for a fact that lots of them were not married. I just didn't know any better. Can we fix this for existing situations where we know that we've got unmarried clients who happen to have joint life policies? There is an easy fix. Have you guessed it? You need to write the policy into trust. That's the correct answer. One of the legal technicians at Vitality provided this explanation this week. They say if the joint life policy is written into trust, then it's outside of the estate of both settlers, both of your clients, both of the lives assured. But for joint life policies, we use a very special type of trust called a survivorship trust. And by the way, every life company who offer joint life first death policies have got one of these. Now, we talked about these on the trust webinar this week. The way that it works is that if both settlers die within 30 days of each other, then the trustees will hold the trust fund for the beneficiaries. So if you think about it, if both clients, or settlers as we call them, die, they can't use the funds anyway from the life policy because they're dead. So these are held in trust and they'll be paid to the appropriate beneficiaries. There won't be any delays due to probate on second death either, which is another benefit. But if we look at the other situation where only one of the lives assured dies, remember we've written the policy into trust, that means that one settler survives. Now, surviving technically means surviving the other life assured, or the settler as we call it, by 30 days. It's 31 days with Aviva. Now, in that situation, the trustees will hold the trust fund for that settler's benefit. So the person who survives will receive all of the policy proceeds and this trust says they're absolutely entitled to them. The Vitality technician explains that means there is no value included in the estate of the deceased settler for IHT purposes. Now, after the death benefit is paid, that value will simply be in the estate of the person who survives. So that is the call to action. Do you have clients who are unmarried? Do they have a joint life policy? Should you speak to them about looking to write that policy into trust? Yes, you should. The situation with HMRC is very clear. They attribute 50-50 of the sum assured of a joint life policy to each life assured. But let me be clear, we're not giving inheritance tax planning advice. There might be inheritance tax to pay on the estate of some of our clients, and we're not even looking at that. We're just looking at the life policy, and all of this that I've talked about today is to make sure that we're not going to cause any further problems in the estate of the person who dies. And remember, writing a joint life policy into trust will also make sure that there's a clear direction of travel in terms of who should get the policy proceeds in the event of a claim. It's also going to make sure that the payout is as quick as it can be. Now, we're talking about a difference of a couple of weeks versus potentially several months, or it could even be years. Now, the alternative solution for unmarried couples is that they take out single life policies, but also, again, they need to write those policies into trust for each other's benefit. If they split up, they can change the beneficiaries quite easily. You can also do life of another, where each partner owns the other partner's policy, but it isn't quite as flexible to adapt to circumstances which could change in the future, such as they split up. But I'd say, with all of this, the golden rule for unmarried couples is to make sure that that policy is written into trust. You definitely need to advise that. I've been a big fan of helping advisors understand the mechanisms of how trusts work over the years. I personally don't think that life offices collectively have made it particularly easy for advisors, because they all have their own processes which are a little bit different, even though the client objective is exactly the same. But using trusts really does demonstrate your expertise and your professionalism. And remember, it's something that your clients can't do themselves. If they do happen to approach a solicitor to draft up a trust, which I don't think they will do, it will cost them hundreds of pounds. How much does it cost to use you? So that's it from me for another week. Remember, I've added a link to next week's trust webinar in this protection update, so it'd be great to see you there if you want to come along. Have a fantastic weekend, and I will see you soon.